Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This show is designed to help us grow our money. You see, the problem is we spend most of our time working to make money in order to eat. Let me say that again. We take our time, we go to work, we make money in order to provide. But imagine living in a world where money could make you money, so you had more time for the things that mattered most: family, friends, engaging in a purpose greater than yourself. That's what this show is about. If you want even more information, make sure you go to everydayinvestor.com. Remember, whenever you're introduced to any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what's the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum amount needed? And 4, what is the risk, the worst case scenario? Super excited about this show. We're going to be talking about how we can make money investing in multi-family properties. Nicole Edmonds on the show. She's going to be educating us on just how to do that. Don't go anywhere. We'll be right back.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back to Everyday Investor. We're talking to my friend Nikki about how we can make money investing in multifamily dwellings. Before we do that, we're going to go to our market expert, talk a little bit about how the stock market's doing with Omar Khan. Omar, what's happening this week?
Thanks, Rav. Hi, guys. Omar Khan here with Beta Trading. I just want to give you an update on how the market's doing and what happened this year. What exactly is going on with the stock market? Well, it's an interesting story. It's been a very tumultuous year in the stock market, but you might be wondering, well, the economy is doing so poorly. Why is the stock market almost at an all-time high? Well, the main reason is because the stock market is a forward-looking mechanism. So what this market is doing is looking forward 12 months. It's saying in 12 months from now that corporate earnings will be really good. We're in a low interest rate environment. Companies will be making a lot of money. And because of the vaccine being rolled out, things will start getting back to normal. That's what the market is pricing in. So it's been a very tumultuous year. The stock market's on average up about 10% for the year, the S&P 500, but it's looking forward. And that's why you're seeing the market at a high, even though the economy seems to not be doing as well. So that gives you guys an idea as to what's going on. Anyways, look forward to being on here regularly. And for now, back to you, Rav, and we'll see you guys soon. Okay, guys?
Thanks, Omar. Always appreciate your wisdom. Nikki, it's great to have you on the show with us.
Thanks, Rob. It's great to be here.
Yeah, what's been happening? Here we are in the new year, 2021. And of course, we've had an interesting 2020. What's happening for Nikki?
Well, on the personal side, the non-real estate side, I've been converting a shuttle bus into an RV. And it's good because it's been keeping me busy during all the weirdness of 2020. I've been busy doing that.
And in 2021, something else really big is happening.
Yeah, I'm getting married, but I was supposed to get married in 2020, but we had to postpone it. So we postponed it a year, but we're not going to postpone it anymore. So we will get married in 2021.
And I can't believe you did all that just because you wanted Rav to be at the wedding.
Yeah. It was really important, Rav.
No, listen, Nick, it's always great to have you on the show. Thanks for people don't know, but for many years and still, you're one of the producers on the show, but you're an active investor. I know you don't like to talk about it, but just so that the viewers and those listening via podcast can know, where are we at with your portfolio? Describe it a little bit and kind of what you like doing now. I know we're going to talk about a multifamily investment, but kind of talk what's kind of your favorite.
Sure. So Yeah, my portfolio has definitely evolved over my whole investing career. Starting with student rentals, moving into multifamily, small multifamily, renovation projects, then to bigger multifamily, um, and then at the beginning, when I didn't have the money to do it myself, I was using different creative financing strategies, joint venture partnering. But now, over time, as the properties that I have given me back funds, now I've also moved into some more passive investing. So lending to active investors who are buying and renovating properties, and doing passive land development deals. And so now my portfolio is a mix of multifamily properties and passive investing strategies.
Talk to me about multifamily investments. Describe it. What's the scale? Anywhere from a few units to big apartment buildings. Talk to me a little bit about that. Help the viewers understand it, and why do you like it?
Yeah, so multifamily property can be a duplex up to a whatever plex, 200 plex plus. My focus has been between duplex and up to 8 plex, so in that range. And the reason I like it, there's a few reasons. So when I started investing, and still, I would describe myself as a very conservative investor. When I started, I didn't have the funds that if this property didn't cash flow or was vacant for a long time, I didn't have the funds to sustain it myself. I needed the property to be completely self-sustaining. So multifamily properties I like because first of all, you have incomes from multiple apartments. So if you have a fourplex and you have one that goes vacant, one unit that goes vacant, you have income still coming in from 3 other units, right? So that mitigates your risk. That's one reason. And then another is when you buy a single family home and you're organizing lawn care and you're organizing snow removal or repairing the roof, you're doing that just for that one property, one income. If you have an eightplex, you still only have one roof, you still only have one driveway and one lawn. So there's this scale that happens there where you are way more efficient with your time and with your energy, and with your expenses, but scaling up the income that you're getting from those properties.
Yeah, I mean, I always say, wouldn't it be great to be able to have 2 rents or 3 rents or 4 rents or 8 rents with one furnace, with one roof? So is this what you're going to continue to do now? Or are you going to probably just stay in the multifamily space, even if you're investing passively? Or if you're investing passively, it really doesn't matter as long as the numbers work for you?
I like multifamily because I do believe in it as a low risk investment strategy. So if I'm going to put my money behind something, I will probably still lean toward multifamily. If somebody pitched to me a property that was a single family home, where we required appreciation to make money and it was a little lighter on the cash flow, even if I was going to be the money backer, I don't think that would meet my criteria because I don't believe in that strategy personally. So I probably will continue to invest in multifamily. And then for the actual properties that I still maintain in my portfolio, I plan to keep those. They're buy and hold properties, and I plan to keep them for a long time because they keep generating income. So why not?
And how many doors do you have? Another word for doors, tenants, clients. How many do you have now total?
I have 41 doors now.
41 doors.
Yes.
Wow. That's fantastic. And not to take anything away from you, I just really find that women are a lot wiser and in the end, more successful when it comes to investing, just because exactly what you said. It's about numbers and you're very conservative. If it works, it works. If it doesn't, it doesn't. And, unlike me back in the day, saying, oh yeah, I'm not quite sure how that's going to work, but we'll figure it out. And then all of a sudden, I've been lucky. I've not lost per se in real estate, but I haven't been able to make necessarily the best returns because I wasn't conservative. I would be aggressive here and there. So thank you for being a great example. And, I'm very excited for what you're doing. Now, when you say 41 doors, how many different dwellings is that? Because obviously we're talking about multifamily. You said you've done anywhere from 2 to 8 multifamily. So obviously they're not 41 different dwellings. How many different dwellings are they?
So it's across 12 different dwellings.
Across 12 different dwellings. So that's great. So you're managing 12 properties, if you will. Now, does Nikki manage these herself, or do you, and kind of give a little bit of the geography, like they're anywhere from where to where. Do you manage them yourself, or do you have a local property manager?
So I actually just recently switched how I'm managing them. But for the majority of my time investing in real estate, I have managed them myself, but I've always done it from a distance. So the properties are spread out quite far across Ontario. And what I've done is in each of the cities where the property is, I'll have my go-to plumber, my go-to handyman, my go-to electrician. But I will communicate with the tenants. The tenants will let me know of any repairs and maintenance issues, and then I'll send over my trusted on-site person to go verify or be there, or do the repair, or be there while somebody else does the repair. So that's allowed me to do that work from anywhere. However, just recently, I've brought somebody else on that I've been training to take over the role that I've been in. So again, they're remote. They're not going to each of these sites, but now they're coordinating. They're getting the communication from the tenant, and then they're sending somebody over to do the repair.
And so now you're just talking to that one person.
Yeah, exactly.
Your assistant or whoever it is. And they don't need to be full time, right? They can just be at like kind of an on-call.
Yeah. I mean, it's exactly, obviously there will still always be a little bit of a role for me in there. Just, there'll be things I'll want them to double check with me, but otherwise, yeah, they'll be doing a very similar role to what I did, which allows you to decide to, call the plumber when you're done having lunch with your friend, or send over the lease to be signed via email in the evening or in the morning or whenever it works for your schedule. Or if you're going to have a long weekend or take a week off, or, you can just manage your schedule around that. So that's for anybody who's going to manage their own properties, or hire somebody else. It's very flexible for when you're going to have things done.
And so with he or she, when he or she's all set up, are you speaking daily, weekly, monthly? How it will work? What will it look like for Nikki?
For me, it'll probably ideally be weekly. I'm maybe a little bit too much of a control freak to completely let go of things. So we'll probably touch base weekly, go over, any tasks or questions, like high level stuff. Right now we've just been training. So there's been a lot more, talking. We talk every day right now, but that's because I just brought her on a couple weeks ago. But yeah, over time, I hope I want to rid myself of the little headaches, because I feel that I'm working more in the business than on the business than I wanted to. So that's why we're making that change.
Love it. Very smart. You mentioned that they're all over Ontario. You're in where? You're up north? You're in London? Where are you?
I'm from Muskoka, but I live in London now. So I've been traveling less in 2020, obviously, been in London mostly, but between the two.
And so of these 12 dwellings, is there any that you didn't see, or you went to all of them to see them?
Before purchasing, I went to all of them, but there's some that I've seen twice. But I have gone to see all of them before, especially if I'm bringing an investor in on a deal, which I've done for most of my deals. I know that they're looking to me to be the one who's double checking things. So I feel the responsibility to go on site and see them for myself before putting their money behind it.
Sure. All right, Nickster, I can't wait to, we'll break down one of your deals here in a multifamily space and educate our viewers, educate Rav, our listeners, all that kind of good stuff. We're talking to my good friend Nikki, and we're going to learn how we can make money investing in multifamily dwellings. Don't go anywhere. Everyday Investor continues in a moment.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rob. Welcome back to Everyday Investor. We're learning how we can make money investing in multifamily dwellings. Nicole Edmonds is the one that is educating us on that. But before we do that, let's go to our mortgage expert with our Mortgage Minute, Kyle Ford. Over to you, Kyle. What's happening?
Thanks, Rev. Today I want to talk about the age-old mortgage question, fixed versus variable, specifically from the investor perspective. As an investor, we might prefer the idea of a fixed rate, being that the mortgage is generally the largest expense in any rental property. The idea of locking in that payment for the set term can be appealing to a lot of investors. The benefit of variable is a set penalty. We know at any point we can break that mortgage with a 3-month interest penalty. Whereas with a fixed mortgage, we could be facing an IRD penalty. This could be thousands, even tens of thousands of dollars. What's the best choice? The answer always depends on your short, long-term, and personal comfort level. If you're going to lose sleep over a variable payment, make sure you lock it in. As always, reach out to your mortgage specialist if you have any questions and let them custom tailor a solution to you. Back to you, Rav.
Thanks, Kyle. Always great to hear from you. Nikki, so let's break down the numbers on one of your multifamily investments, and we'll go through kind of the questions that we always ask. Get us to the return on investment. When do we get it? What's minimum needed generally? And what's risk? What's the downside for people to be able to look out for? So I've got my marker here. You tell me what we're doing.
Okay. So this property that I brought, it's an 8-plex, and it's located about 4 hours north of Toronto.
Okay.
I purchased it for $525,000.
$500K?
Yeah.
Okay.
So with that, it required a down payment of $157,500.
$157. Okay. So how was that calculated? That's all you had in the bank, or what'd you do?
No, so that was the 30% down payment that we needed.
And is that what it was? It was 30%?
Yeah.
And that's because, Nikki, because in different places, I mean, when I want to buy a primary residence, I need 5% down. And when I want to buy an investment property, Toor, just a single dwelling, 20%. Is this now considered, because it's an 8-plex, this is commercial real estate?
There's different lenders that will lend to you as residential or commercial with 8. I think there's very few that'll lend residential. This one's residential, but the bank did want 30% down for this.
30% down. Okay. So 30% down of 500 is 157,500.
The purchase price was $525, and so the 30% down was $157,500. Yeah.
So $525K. Okay. Here we are. So that's our down payment. What else?
Okay, so there was closing costs of $14,000.
How much?
14.
Okay.
Okay, and then this was a property that needed a full renovation, a full cosmetic renovation. And the renovation that we put in was $100,000.
$100,000. So that doesn't sound like a lot of money for an 8-plex. What did you do?
Yeah, let me tell you. So because of where this property is, it's like downtown of the city. It's not in a super high-end area. It's in a medium area. We did not put in granite countertops. We didn't put in new hardwood floors. We were very particular about the renovations that we were going to do. So all of the units had some original hardwood that we had buffed and restained, and they looked great when they were done. We put new floor in the kitchen and bath, new tile in the tub surround. We saved the tubs that we could, cleaned them up with tub paint, like enamel paint. And then we redid the kitchens. The kitchens were quite small, but we ripped them out and did new cabinets, countertop, sink. And then instead of getting brand new appliances, we got refurbished appliances that looked great. They were white, they were updated, but they weren't brand new stainless steel. So we were very choosy about the renovations we were going to do. And the reason for that is in that area, if you put in granite countertops and all these really high-end finishes, you're still going to be held down by the area. You're not going to be able to get the top rents. You're not going to be able to have it reappraised for the top dollar. So you have to know the area that you're working in and know kind of where the ceiling is and make sure that you're making renovation decisions that are still going to leave you a great room for profit.
Okay, great. And when you bought it, was there vacancy? Was it all tenanted?
Yeah, so it's 8 units. 2 of the units were tenanted. 6 of them were vacant, and I would describe those 6 as unrentable. they were awful. They were really ugly, really dirty. They absolutely needed an overhaul. But I mean, with paint, with those new cabinets, and just some TLC in there, it's not, it doesn't require a ton of money to make it look completely differently.
Okay, great. So is this our total expenses?
That's our total, yeah.
Okay, what does that add up to?
So we're in for with the renovation costs, we're in for $271,500.
$271,500. That's what we're in for here. And of course, I need to play with different colors. So this is our all in. Now, whether Nikki, you broke the piggy bank and used $270,000, or whether this was all from an investor and then you split the profits, it's irrelevant right now because I want to see what the return on investment would be. So here's how we make money. Teach us how. So what are the different ways in that area? Obviously, we have passive appreciation, right? So how much would that go up? What would you give yourself that just naturally over a year this would go up?
So in this area, and a good conservative rate of appreciation is 3%. So that's what we used, was 3%. But we didn't apply 3% to that purchase price. We purchased the property, did the renovations. Now the property was worth more. And going forward, it'll appreciate from that newly appraised price.
So what was the new price?
So the new price that it was appraised for was $850,000.
What? So an appraiser, we bought for $525, we put in $100, $625, and you were able to get it over $200,000 by the work that you did.
Yeah, and in this property, when you look at it and you think, oh yeah, okay, it's ugly, I can renovate it. There's other opportunity here. It was the vacancy was huge in this building. So the purchase price was really low because a lot of new investors were very scared to get in and buy this property. So you clean it up, and now we could fetch rents that were much higher than those 2 units that were tenanted. I think our average rents went from $500 per month, which was those 2 tenants were paying, up to an average of $1,000. So, you can turn around the whole income formula and have it reappraised for, $850K in this case.
Love it. So 3%, 3% of 850 is?
3% of 850 is $25,500.
So 25,500 is what passive, but of course you lifted this property. Right? You actively shot it up. So active was how much? What's the difference over there?
Yeah, so the active appreciation would have been $225,000. So that's the difference between the $850 minus the $525 and the renovation cost.
Okay. And then of course they're paying you. So we have cash flow.
Yeah. So once we got it all rented, it was cash flowing, and it cash flows $16,300.
$16,300. That's after all expenses.
Yes. And a vacancy allowance and repairs and maintenance allowance and property management fees. Yeah, everything.
That's fantastic. So you're making $16,000 a year on this after all expenses are paid. And then of course, the one that I love the most is the mortgage getting paid down, right? Every single month. We have people that are paying the other 70%. So we put 30% down, somebody's paying down, or 8 people and whoever they're living with is paying down our mortgage. So at the end of a year, how much is our mortgage being paid down?
Our mortgage pay down annually is $14,200.
$14,200. Okay, Nixter. So if I add the passive appreciation, the active, the cash flow, and the mortgage, what's that number?
$281,000.
$281K. Okay. And so obviously when we want to work this out, I mean, we're over 100% just here. we take our profit, 281,000, and we divide it by 271,500. And what does that spit out?
It gives us 103%.
103%. So my ROI equals 103%. Just to get really excited about it, we'll use red, but red means we're losing money, so we won't use red. We'll use orange. How about orange? And we'll circle that. No, but Nikki, 103%. That's fantastic. Now, do me a favor. Do you have your calculator with you?
I do.
Okay, let's not use the act of, let's just take that out. I know we're still done the renos, but if we didn't use the act of appreciation, 25,500 plus 16,300, mortgage pay down 14,200, that spits out what?
56,000.
Take the 56,000 and divide it by the 271,500.
So divided by the 271,500, it gives us approximately 21%. But remember that after we do the renovations, we refinance the property, we get to take out our renovation cost.
That's right.
So when I ran it after taking out the renovation cost, it gives us 32% going forward.
Yeah, but I'm saying 30% after you took out the difference. I mean, that's another property, right? That's another, we're moving on to the other one, not by refinancing, just by the fact that you were able to lift that. And if we didn't have that, if we didn't calculate that in, I'm still making 30% on my money. This is what I love about real estate investing. I mean, you were able to do this, and you said it's what city? It's about 4 hours north of Toronto. Where are we there?
In Sudbury, Ontario.
In Sudbury, Ontario. Yeah, I mean, Nikki, this is fantastic. And so you're continuing to do this. You've hired an assistant. We're out of time, but before I let you go, if somebody says, hey, Nick, I want to do this as well, kind of give me the top 2-3 things. Sorry, I didn't prep you on this. What are the top 2-3 things that if somebody's like, I have a condo, I have a single dwelling, I even bought a property where I rented out the basement, but I want to get into a 5-plex, a 7-plex, an 8-plex, just at a very basic level, what are the top 2-3 things that they need to understand?
Yeah. So I think that they need to, watching your show, listening to podcasts, going to seminars, they need to get the education to understand how to run these numbers and run more formulas like this so that they can evaluate a property and make sure it makes money. 2, I think that they need to see, what they have. Maybe they've got the cash. Maybe they don't have the education. Maybe they've got the education now and they don't have the cash, and they need to go find a joint venture partner. So kind of evaluate what you're bringing to the table and then go find, the bits that fill in those holes so that you can get one of these deals done. And lastly, I would say find somebody who's doing this the way that you want to do it and has achieved what you want to do, and follow them. Because there's a ton of info that's out there from people who tried rental properties and failed and now want to tell you why it doesn't work. Don't follow that person. Follow the people who are doing what you want to do and just use their proven system.
Love it. I heard you say, get knowledge. Knowledge mitigates risk. It also breeds confidence. I heard you say, know what your gift set is in this. And then thirdly, I heard you say, get a mentor that's actually doing this. Nikki, thank you so much for being on the show. Really appreciate it.
Thanks so much for being here, Rob.
And thank you, viewers at home, for watching the show. Without you, we would not have one. Make sure you tune in next week. Same place, same time. Honey, I love you. I'll be home soon. Bye, everyone.